Hello and welcome to It's No Secret. I'm Kat, and today on the show we have a very special guest in the form of Tim Edwards. Tim is Global Head of Index Investments at S&P Dow Jones Indices. He's a PhD level maths nerd and someone much smarter than myself. So today we are going to talk about investments, recent market trends, how to pick stocks or not, and a little bit more. Formerly, Tim is actually Managing Director and, as I mentioned, Global Head of Index Investment Strategy. You've probably heard of us talk about S&P Dow Jones a few times on the pod before, so particularly when referencing anything about index versus active investing. Tim hails from London. He has worked in derivatives through to global equities. His team crunch data on over 2 million indices per day. That is a lot of numbers and, well, as we were just chatting before, not a lot of spreadsheets. Presumably using software far more smarter than Excel. But today we're going to pick his brain, probably have our heads spin a little and learn something new about investing. So, Tim, welcome.
Thank you very much.
No worries. All good. So tell us, a lot of people have heard about S&P in a few different capacities, but what does the Dow Jones Indices part actually do and what's your role there?
Sure. So S&P Dow Jones Indices is the name of a company that calculates indices. We've actually got quite a long history. The very first index ever was invented by a chap called Charles Dow. It's called the Dow Index. It's still going today. 127 years of live index history.
Wow.
But we have expanded from just an average of $30 to, as you say, a lot of indices measuring markets around the world. And as an index provider, as a financial data company, our mission is to measure markets worldwide and to also support our clients who will create products tracking for indices, like, for example, index funds, but not only index funds. And I run a 7-strong research team. And what we try to do is to offer people insights on what all that data is telling us, telling you, to advocate for the role of indices as the basis for investing or trading or benchmarking, and to help the overall community of people using indices to get greater value out of the indices they use.
Awesome. So you mentioned the word benchmarking. I think a lot of people would probably be familiar with, the little market tickers that they see on the news and, in the New Zealand context, seeing like the NZX50 and those sorts of things, but maybe not have the understanding of how that data is powered. So, for just a regular person, well, who is using some of that index data? Is it mostly investment managers? Is it also an exchange? How do those things play?
Yeah. And actually the NZX is a good example of, how we as an index provider will often work in partnership with other organisations, the New Zealand Stock Exchange. So it is, its full name is the S&P 50.
Yes.
They're obviously the exchange all day, every day, or not quite every day. People are trading shares.
Yep.
And at the end of the day, you'll get a closing price for those shares. And what we will do as an index provider is take those closing prices and put them into our analytics engine and come out with that day's value for the broad means of the stock market, the 50, the NZX 20. Now, what are those? What does it mean? What is the Dow? What is the S&P 500? What they are hypothetical, if you like, portfolios. They represent baskets of shares. And again, they can update intraday, and at the end of the day, they essentially represent a portfolio. But in the case of the NZX 50, in the case of the S&P 500, in the case of a lot of other well-known indices that you'll see scrolling across the business TV, they're a very special kind of index. And I'll just briefly explain what makes them so special. So if you think about a market like the US, there are big companies like Apple. There are smaller companies, S&P Global. And there is more money invested in the big companies than the small companies. That's what made them or makes them big companies. But if you add up all the money invested in the market, then so you add all what's added in invested in Apple, all that's invested in S&P Global, all that's invested in all the other companies. You sort of imagine this enormous pot of money, all the money that's invested. Now, market cap weighted indices, technical term, market capitalization weighted indices, what they do is they represent that overall portfolio. So if Apple is 4% of the US stock market, your index will have 4% allocated to Apple, and so on. So the S&P 500 is built like that. The NZX 50 is built like that. Now, what makes these so special is if I tell you that the S&P 500 is up 1% today, what that means is that aggregate pot of capital, all of it, is up by 1%. So they give you a proxy, they give you a measure, indication for how everyone is doing. So it's just one real convenient shortcut to say, how did the market do? The market was up 1% yesterday. And that, in fact, goes all the way back to the roots of indexing to Charles Dow, who actually he created his index because he wanted a way to say, overall, this railroad stock might have been up, that railroad stock might have been down, but how did the market do? So why don't I calculate an average? And that's what he did. Initially, he published it in something called the Customers Afternoon Letter. That later became the Wall Street Journal.
Amazing.
And to this day, whoever the present editor of the Wall Street Journal is, they actually are invited to give input on what should go into the Dow over time as it evolves.
Awesome. That's such a cool story. So I guess for, speaking of the index itself and tracking that and having a look over time, whether it's on a daily basis or even monthly or longer at, that kind of aggregate movement up or down, presumably this is helpful for both regular investors who just want to, if they are investing in index portfolios, see what the general movement is as a proxy for their portfolio. But it would also be helpful, I guess, for people that are the stock pickers at heart, because they are comparing it presumably to how they individually have gone on a daily or monthly basis.
Yeah, and I guess that gets back to the original question around benchmarking. What does that actually mean? And why might you use an index as a benchmark? Well, we sort of explained how these indices represent how everyone is doing in aggregate. That's a really natural point to compare yourself to, whether it's over a day, whether it's over a month, whether it's over a decade. If you have a process that's adding value, if you like, or offering insight in terms of investing, then you might hope to be better than average. And market indices like the NZX 50, they tell you what average actually is. How's everyone doing? And that's why they're really attractive as benchmarks. If you're beating that index, then by definition, you're doing better than average.
Okay, cool. So I do want to touch on SPIVA because I know, being better than average is basically, SPIVA is all about that. And listeners of the show have heard us talk about SPIVA in a little bit. But before we get there, a couple of questions for you personally. How did you get into the indexing space? Because as I mentioned at the start, you had obviously had work experience in derivatives, which is very different from indexing. Fun fact, derivatives is the only subject I failed at university to get my finance degree, so you're not going to convince me on that one. Much more in the indexing game. But how did you end up here in terms of, wanting to do this as a career?
So I once upon a time, I was a pure mathematician.
Hence the PhD?
This was back in the early 2000s.
Okay.
Back in that time, there was, the application of mathematics in finance was still reasonably new. And back in those days, you could actually have a pure math PhD, and you could go and investment banks would say, yes, please come and work for us. I feel like I was the last sort of philosopher to go through those doors. Nowadays, there are dedicated finance and PhD.
Quant teams.
Back in those days, they didn't have those programs yet, and they were inviting physicists and mathematicians in. I say this with some, but not much. I sold out. It's exciting. Go and work in finance. Go and work for an investment bank. Initially in London, and then in New York. I moved to New York in the summer of 2008 to work in derivatives. Your listeners, I should say, may also know that in terms of working for an investment bank,
Great timing.
Renee. was not a particularly great time to be working in hedge funds and other derivatives. But do you know what? It was a fascinating learning experience.
Mm-hmm.
And I worked for 5 and a bit years in derivatives and the sort of esoteric worlds, doing things like products based on volatility, and I learned a lot. But I also came to realize that there was another part of financial services where the outcomes were better and where the approach was less about, well, I don't want to say gambling, but gambling and, competing.
Yeah, being the best.
Beating
Yeah.
competition.
One winner for everything.
Yeah. And that was then the still reasonably nascent world of index funds and
Right.
ETFs.
Yeah.
And as someone who had once upon a time had a very rigorous mathematical training, there was something appealing about the index world. There was something exciting about how a simple story not only resonated, but also made sense.
Right.
And I left the investment bank, and I knew I wanted to work at one of the very few places. One of those places was S&P Dow Jones Indices.
Yeah.
Started working there about 10 years ago.
Awesome. And it's taken you around the world, even to New Zealand.
It has taken me all the way around the world, indeed, yeah.
Yeah, love that. Nice. So getting back to, I guess, the retail investor space, because, most of our listeners are, I'd say, pretty familiar with index funds, probably already on a passive investment journey of some description. We definitely skew female in terms of our listenership, but we've got all sorts that listen. And I guess, whilst we have you here, as a retail investor, what are sort of 2 trends that we should care about? Because it's really easy to get caught up in news headlines. It's also really easy, being in New Zealand, to stay hyper focused on maybe what's happening in our market and our very small sphere of the world, and not have such a good global perspective, particularly when we haven't been able to travel and get that perspective too easily. So as someone that has, and from what you're seeing in much bigger markets, what are some trends that we should actually be paying attention to?
Well, look, it's never easy, in terms of investing. It's never easy to know what to do. It's never easy to feel confident that you're doing the right thing. But the past couple of years, through COVID and through last year, they've been harder than most. It's not just the fact that equity markets have gone down around the world. It's not just the fact that rising interest rates have meant that bond markets have also done badly. It's not just the fact that it seems like the pace of change increased rapidly over the past couple of years. And it's not just that if there's a feeling of the wind's changing, and worried that you're in a plan that was built for 2019 and you need one built for 2022.
Yeah.
So I have a lot of sympathy for those who feel tired, frankly, with all the challenges that they face. How do you deal with it? Well, I think there's 2 things to bear in mind. The first is to understand that as investors, our own instincts are often incredibly unhelpful. What we tend to do, there's plenty of evidence to support this, is what happens is when the markets are going down, when there's a crisis, when there's a panic, we do 2 things. The first thing is we want to panic as well. We want to run away, and I get it. It's a headache, worry. We want to just go out to the sidelines. And secondly, it's fascinating, there's data on this, we tend to check our account balances far more often.
Yep.
Like when this is just a phenomenon. Some of your listeners may not do this, but the data suggests that the majority of people do this. When things are in the green, when it's positive, you don't check, you leave it alone, you're happy. When those nasty red numbers come along, you check next hour, and you check again, and you check again, and it's just not helpful. It's not helpful. And it's not helpful is because actually those times of panic are really the worst times to sell. And there's times when everyone's full of fear of missing out, and everything's going gangbusters, and it feels like you can't make a mistake.
Yep.
In hindsight, those are often the worst times to buy. So our instincts act against us. So how do you manage those instincts? I think and I think there actually is a solution to that. And it's, I hate to sound like got to have your vegetables, and this is the solution. Build a plan and stick to it. Now, you might get help from a financial advisor in doing that, and I think there are some very good people working in the financial advice service who that is what they will do. They'll help you build a plan. They'll help you stick to it. And when it feels like, the world is collapsing all around you, that's when they can hold your hand through that and say, look, this is part of the plan. They should have built it so that if there is a panic, you'll be okay. And it's not a good thing to happen, but if they build their plan properly and they build their portfolio properly, there should be some things that are holding up. And there should be a strategy for managing through those times of panic. Because in the long term, and I do mean in the long term, equity markets have grown almost everywhere in the world, and they've grown at a pretty attractive rate, and that's why they're part of the mix of growth assets that can help people save for retirement. But in every market around the world, there are times of crashes and panic. And so acknowledge that your instincts are not going to help you. Find a plan. Maybe work with an advisor who can help you with that, and stick to the plan.
Love that. It's like you've been on the show before. We talk about this a lot because I think Christine and I are very open about the things that we're good at and the things that we're not so good at. And, some things that we're not so good at is probably declaring what we're going to do with our finances and money and investments, and then actually checking back on that a year later and being like, well, how much do we keep ourselves to account? And it's very hard to keep yourself to account. So definitely having an outside perspective for that is a super important thing. We've touched on it already, but talk to me a little bit about the active versus passive debate, because our listeners know that we love index funds. We're clearly very biased. We work at Kernel. We're very open about that. But we also talk a lot about core satellite and the fact that, investing isn't a religion. You can have a bit of everything. There's no one right way to save for retirement. But there's obviously some data that is very strongly pointing us in the right direction. So what is that direction and what does the data show us?
Let's start from the following. Everyone is an active investor.
Well, that's good to know.
Everyone's an active investor. If you take that context, saving for retirement. No index provider, no index fund provider is going to tell you should have this much in property, you should have this much in cash, you should have this much in equity, this much in international stocks.
Yes.
In fact, they won't. Because the correct answer to that question, how much should I have in all those, is it depends. It depends on your risk tolerance. Depends on what your goals are. It depends on what your needs for income are. Depends what, how we talked about, that behavior of getting through the tough times. What do you need in terms of how much defense have you got playing for you to be able to stick to that plan in the challenging times? So we are all, if we're invested at all, we are all active investors. The question is, where do you want to be active and where should you spend your time? And what our Speaker scorecards help you do is they show you where, if you look within a market like New Zealand equities or Australian equities or global equities or global bonds or sovereign bonds, etc., they'll show you the hit rate of actively managed funds versus benchmarks. And what that helps you do is decide, okay, where do I spend my time? Do I spend my time at the sort of top level, thinking about my asset mix, thinking about, do I want exposure to global companies like Apple and Amazon and so on, or do I just want the New Zealand market? And then once you've made that decision, as let's say, yes, I'm going to have some equity exposure. What's the next step? Do you then say, okay, right now I need to spend, or however long it is, finding the best manager who's going to beat the market there, or not? And it does actually take a lot of time and effort to identify a fund manager who might outperform in the future. And the reason it takes so much time and effort is because the odds are stacked against you. That's what our Speaker scorecards show. They show that just picking one at random is no good strategy. And in fact, finding managers that will outperform over the long term is really, really tricky because there's extremely few of them. So what that data suggests is, it doesn't tell you that you shouldn't have active investing, but it does tell you that it's not a terrible decision to focus on the asset mix and then use the index fund building blocks to get broad market exposure, which at least you'll get a little bit of everything in there. And
Yep.
you'll probably end up doing okay, and you'll probably end up doing okay versus the alternatives in terms of stock pickers.
Yes.
And you mentioned this notion of core satellite, and I will make a confession here. Even though I work for an index provider, even though my team produces the SPIVA scorecards, in my own personal investing, the core, most of it, is in low-cost index. However, I do have a core satellite approach, which is most of it in low-cost index funds. And then the stuff around the edges, I like to add a little bit of chili sauce.
Yeah.
I like to have a bit of fun.
Yeah.
And I know that the odds are stacked against me. I know that I'm not smarter than the average investor. But nonetheless, that allows me to, just, in terms of what I do, it allows me to engage, to engage with markets, to have a reason to keep up on the news. But I know that what I'm doing there is I'm having a bit of fun. I'm making a few bets. But it shouldn't, even if they all go wrong, it's not going to damage me too much. Because the core of my portfolio is driving the returns. Absolutely.
Awesome. So on that, I think it's really important to note, because one of the things that we've often talked about on the show is the fact that, we are who we are as people, and it's really hard to sit on our hands sometimes and just let our investments do their thing. And this whole psychological mindset around less is more when it comes to investing is one that people really struggle with. And I guess I'm quite interested in that, even though the data has shown us consistently, and your team have some data sets that run over 30 years now in terms of active managers beating the S&P 500, for example, even though the data shows us that is exceptionally challenging for people to do on a consistent basis, a lot of investors are still quite resistant to just accepting that we're better to have that broad market exposure in the core and keep it simple. So do you have...
Back to the instincts here. I mean, if it is terrible, the best advice is don't just do something, sit there.
Yeah. It's counter to everything else in your life.
Especially in those times of market panic or crisis, all the numbers are red, things have gone down, it's terrible. There's such a strong instinct to do something about it.
Yes.
Fix it.
Yep.
The challenge is that we are, to a large extent, we're not powerless, but we're massively disadvantaged in our prospects for success in doing so. And so we talk about, I didn't talk too much about the satellite stuff. I try to be contrarian.
Yep.
I try to, it took a lot of courage. In March of 2020, when everything was panicking and everything was selling off, I took a really deep breath and I actually put a bit more money in the stock market. But it was terrifying. It's absolutely terrifying to do that. People often talk about their successes, and I should qualify this by saying, on average, I think most of the time my own little personal active decisions have, on balance, cost me more than they benefited me. But to that point of trying to act against your worst instincts, to trying to control what's going on, yes, to the point, what should you do? Stick to the plan.
Yep.
Can be.
Yeah, it definitely is. Definitely is. Awesome. To round us out, what are your top tips, or there might be a couple, but if there's one, that's also fine, for, I guess, looking forward, right? We've kind of come out of this really choppy market period, particularly for Kiwis at the moment. Life feels super expensive. I think for a lot of people, they're probably grappling with rising living costs, but also wanting to future-proof and continue with investing in various ways. Rising interest rates are making, I guess, portfolios and overall asset allocation look a little bit skewy at the moment. Do you have any kind of top tips for people that are still got a long-term horizon, probably got realistically 30 years ahead before they're needing the bulk of their retirement money? How to, I guess, see the wood from the trees in this type of environment?
Yeah, I mean, I have to be somewhat careful because I don't think generally the world wants index providers to give investment advice.
That's fair.
They want us to just measure what's going on and report it accurately and not try and predict where the index is going to go next. But if you look historically,
yes,
it always feels like, this is a new environment and it's never been as challenging as it has now. Actually, roughly every 7 years or so, you get a downturn. And the advantage of working for an index company that has, we mentioned the Dow, over 125 years of market data to analyze, a long-term perspective really helps.
Yeah.
And this time is maybe not different, because there are consistent patterns of behavior over the decades. Talk about, it's true, different parts of the economy come to the fore, interest rates go up and down. As a little tidbit for you, in 1900, more than 60% of the US equity market was railroad stocks. They're just less than 1% today.
Wow.
These things change over time.
Yeah.
The world evolves. I guess my top tip is think about what for you individually is going to be a way. Do you get help from an advisor? Do you make your own decisions? Read your own data? What is going to help you stick to the plan? And I know I've come back to that, but it's so important.
Yeah.
And that really is, that would be my top tip. Focus on the long term, take a deep breath, and think about what's going to help you get there on your journey.
Yeah. Love that. Focus on what you can control, not everything else, as we say with the markets. Yeah, absolutely. Awesome. Well, thank you so much for your time today, Tim. Hopefully everyone has enjoyed that little chat. As always, everyone knows the drill. If you have any questions, you can see us on Instagram at It's No Secret NZ or shoot us an email. We will link to some things in the show notes because Tim and his team have published a number of really awesome articles, and I know that we have some super